good morning to everyone. My name is Jordan Rosen. I am a director and shareholder at Belfint Lyons & Schumann in the Tax and Small Business Department. Welcome to this edition of Highlights of the COVID-19 Relief Bill. There is a lot these days coming out of both Congress and also guidance from the IRS and the SBA. So we have a lot of ground to cover today. And I do want to emphasize that what we talk about today are the rules as of today. I can't emphasize that enough because things are literally changing daily. So after today, if you want to keep up with any of the changes or see if anything has changed, please go to our website at www, make sure you have 3 W's there, .belfint.com, and go to our COVID-19 resource page. And there you're going to see a lot of articles and a lot of blogs and a lot of updates. Since so many of you signed up to hear about the Paycheck Protection Program and loan forgiveness, we're going to be starting out with that topic today. Our speakers for that session will be John Patterson and Mike Kelly, both of whom are principals in our Tax and Small Business Department. So with that, let me turn things over first to John Patterson to start things off. John, it's all yours.
We have a lot to cover with the Paycheck Protection Program today. So just kind of a lay of where we're going to approach this. We're going to go over a brief overview of where the program started. We're going to talk about updates and rule changes that are constantly coming out. We're going to go over everyone's PPP round 1 forgiveness and what that process looks like, the round 2 applications. We're going to go over what changed in the December CAA change, and then where we're going to go from here. So with that, let's jump right in. So just a brief recap of where we started. The Paycheck Protection Program came out of the CARES Act, which was signed March 27th of 2020. The program had a lot of demand, and as many people know, it didn't have an optimal rollout. The plan was originally funded with around $350 billion. Those funds ran out relatively quickly. We had a PPP Increase Act of 2020, which added another $320 billion, and those funds were never used. One of the main issues with the program of the rollout was the guidance by Treasury and SBA was not timely and kept constantly changing. So we're going to get into today where you can access that information outside of our Belfint resource page if you're looking for the actual text and Q&As and forms. So let's move forward here. So let's talk about an overview of what the program is. Everyone probably knows this, but they were loans provided to small businesses to keep workers on payroll. The loans are forgiven if the employer met certain criteria and the funds were used for the eligible expenses. So when we started out the program, the eligible expenses included payroll costs, mortgage payments, rent, and utilities. We're going to see in a couple minutes here how the CAA expanded these covered categories for an additional 4 areas for spending those funds. In addition, we know that at least 60% of that loan from the PPP had to be used for payroll. If you had a reduction in wages, the number of employees, that loan may not be fully forgiven. Also, everyone asks on the forgiveness and when the loan actually starts. It's 10 months after the coverage period ends. And that is either on the 8 or 24-week coverage period. Everyone had the option of choosing that. So after those 8 or 24 weeks, you have 10 months to apply for the forgiveness. And then if you don't, the loan would start at that point. Tax treatment. In the beginning, the IRS came out and said that this was taxable income. by disallowing the deductions. With the rule change in December, we know now this is not taxable income and actually counts as an increase to your basis. And then, as everyone knows, the devil is in the details of this program. So where are we currently? The Treasury and SBA are updating everyone on the program pretty constantly. We have updates as recently as this past week. And where are we at with the program? So the first loans, there's a first loan draw if you never received a loan in 2020. And that opened up on the 11th. Then we have the second draw loan, which opened up last week. And that was for borrowers who had received funding the first time around and are eligible, as we'll get to, on a second draw. And then we're worried about forgiveness right now. Forgiveness on the first loan that was received, and then eventual forgiveness on either a first draw loan or a round 2 second draw loan. And then we'll talk about the changes, as I mentioned, from the CAA on what actually changed with regard to the new categories, the 25% reduction, et cetera. So where does the information get published and how can you stay up to date on it? Outside of our email blast, you're going to see that the Treasury and the SBA both have a website where they publish information. So I believe you'll get a copy of this, but the Treasury website is there and the SBA website is there. My personal preference is the Treasury website, and I'll show you why. It's broken into 5 different sections. So it has an overview of the program and data, has the information for the borrowers, the information for the lenders, which there's a couple actual items in there that may be helpful for the borrowers, a lot of program rules, and the Treasury website actually keeps the previous version of applications and forms available so that you can see the historical. So let's take a look at each one of those sections and let you know what is most helpful. So if you go to this web page at your convenience, there is the top section, which is the overview of the program and data. So the one thing here I want to point out is there's this 1-page PDF on both of these that are top line overview of a first draw PPP loan and a second draw PPP loan. As you'll see next to them, they have a date. So the Treasury site will actually update and put the most recent date that these either overviews, applications, forgiveness forms, et cetera, are updated. All right, so then, I know this is small and I apologize for that. And this doesn't even encompass the full level of detail that's on the Treasury site. So for borrowers, in this section, you'll see that there are applications for a first and second draw loan. And then there's also applications for forgiveness towards the bottom there on that first column. You'll see a lot of those were actually updated on the 19th of January of this year. In the lender section, majority of this will be for the lender, but the one thing that actually came out that got put in that category is the loan necessity questionnaire. So anyone who received a PPP round 1 loan in excess of the $2 million actually got this loan necessity questionnaire. And it was updated on the Treasury site for the actual form. So that, even though that could be used for the borrowers, it's actually in the lender side as well. Program rules, just to go over this, there is a lot here. And a lot of this information is old. You'll see some of this dating back to April of last year. One of the main areas that's helpful is the frequently asked questions. The Treasury and SBA will update that with new FAQs, and they will note within the FAQ file what has been updated. In addition, we get new guidance This is about half of the guidance that's on the program rules. That new guidance does have the date next to it on the most recent update. So for anything that came out in 2021, it will have that date, which is incredibly helpful. So you're not searching through all of these program rules. And then lastly, I talked about the prior applications and previous versions. So a lot of information was updated because of the December bill, the CAA, that got passed. It's helpful when you're applying now for your second round, and we'll talk about why, to go back and look at those old applications. So the Treasury site does a really good job of keeping an historical record of those prior applications on the website for reference. So let's talk about the first draw loan very briefly. So a lot of people during the first round returned funds or applied and didn't take the full amount. So they went back and opened up what's called a first draw loan. This opened on January 11th, and it's really for anyone who didn't apply the first time. So there's a little bit of information here on who can apply. It's pretty much anyone who could apply the first round: small business entities, 500 or fewer employees, nonprofits, etc. You can reapply for the first draw loan. So if you did not receive a loan, you can reapply if you paid some of that loan back, or if you returned all the funds altogether. This program, again, opened on the 11th. There was not a lot of first draw loans that actually went through based on SBA data. On the 19th, they released that there was about $5 billion of loans, so 60,000 loans that actually went for the first draw. So people who did not go the first time on it actually decided to take the draw on the second. So let's talk about the second round, which I assume most people are going to be interested in. So the CAA that was released in December modified the rules of the program. So the eligible borrowers who can apply for the second PPP loan, businesses, nonprofits, which include the 501c6s, and same with the self-employed. They modified the maximum loan amount to $2 million. And then they talked about the employee count. So remember the first time it was 500 employees, now it's 300. There is a little bit of a caveat there with the restaurants, which we're not going to get into, but just keep that in the back of your mind if you're in that industry. This program opened last week on the 19th. So we're about a week into the application period right now. And the program ends March 31st. So as you'll find out after when Mike Kelly starts talking about the ERC, there's going to be a little bit of overlay and potentially planning opportunity with the PPP and the ERC. So just keep that in mind that there is a hard stop on March 31st. So some of the provisions there to apply for a second PPP loan is you have to have used all of your first PPP loan by the date of application. The big key here is that forgiveness is not required. You must demonstrate a drop in revenue of 25% for any quarter. That's a 19 quarter compared to a 2020 quarter. Or you can have a drop in the full year. We're going to go into how we define that drop in revenue in a couple slides here. And that's pretty key. So you don't have to have forgiveness, and you have to have a 25% drop in revenue. Another big question is, does your PPP loan on the first side that you got for round one count as revenue? And the answer is no. Again, you can't engage in political or lobbying activities as a primary to apply. If your first loan is under review by the SBA, so I don't know if this may have happened to some of you, but if your lender submitted bad documentation on the first round, the SBA could flag that loan as being questionable. So if you got that correspondence from your lender, you would want to clear that up right away in order to be able to apply for a second round. It's essentially a little bit of a blacklist on what entities can't apply again. So you would have to work with your lender to make sure that they have all the information if your loan got flagged by SBA to clean up those open items. And it could be as simple as, you put, if you're a Schedule C, you put your social down instead of your EIN. That could flag you by SBA as not being appropriate. So just something to consider and make sure that you're not missing any communication on that. Same as the first time, 2.5 times your average monthly payroll cost. That's going to be a little bit different. That's in the first round, we were trailing 12 months, and then we moved to just 19. This time, it's either going to be 19 or 2020 for the payroll cost. There's a couple caveats there, but we're not going to get into those details. The food and accommodation service industries, they get 3.5 times on the average monthly payroll cost. So a little bit of an extra benefit for those hardest hit industries was wrapped in. And again, as I talked about in the previous slide, we talked about employee count, 300 for most, but the food and accommodation services are 500. So again, we're giving a little bit more leeway to the food and accommodation because they are the hardest hit. There was a change in the definition of payroll costs from the first time. So as you remember before, we just had medical costs for insurance. This CAA changed that by including life, vision, disability, and dental that the employer pays. So a little bit of a change. If you are resubmitting with 2019 for your second draw loan, you might want to consider the modification to your medical expenses as an additional payroll cost that has to be factored in. So let's run through some calculations here. So we're going to run through basically three scenarios. We're going to talk about a Schedule C with no employees. We're going to talk about a Schedule C with employees, a partnership, and then after that, I will tell you how the S and C Corps are going to work. And they're basically going to follow a partnership as if you didn't have any partners. So the first one for a Schedule C, which is the most straightforward, they're going to look at, with no employees, they're going to look at the net profit from that Schedule C up to 100,000. Same as the first time. Divide that line by 12, multiply it by the 2.5, 3.5 if you're in the restaurant industry, and that's going to be your maximum loan amount. Schedule C with employees, we're going to do the same thing as we did on the first step. So you're going to factor what your total profit is from your Schedule C, and then you're going to figure out what the employee cost is. So this is employer wages, employer contributions for group health, life, disability, vision, and dental insurance. And that's the modification there. The first time it was just health. Now we add those four other buckets. Employer contributions, the retirement plan, nothing new there. And then the employer, state, and local taxes assessed. This is really the state unemployment. Very little dollar amount there for most people. So we're going to add up those four items above and divide by 12, multiply by 2.5 as long as we're not in the restaurant industry. And that's going to be our maximum loan amount. So we include the 100,000 up to for a Schedule C profit, and then we add in the employee portion to calculate the maximum loan amount. For a partnership, a little bit different here. There was a lot of discussion the first time around with does a partner count as an employee? And if you remember, during that first time, there was the opportunity to apply for a second loan if you had excluded the partners from the calculation. So this is pretty important to make sure everyone understands if you are a partnership. So the earnings on Schedule K1, self-employment earnings, are multiplied by the 92.9235 up to the 100,000 to get the amount of the partner's quote unquote wages or self-employment income that would qualify for the PPP loan. And there's a calculation there that has the net earnings from self-employment, right, which is 14A of your K1 on your 1065, and you're going to subtract any 179 that was claimed, and then if there's any unreimbursed partnership expenses claimed, an adjustment for that as well. So if it's over 100, you're going to reduce it to 100 because you can't get more than that. If the amount is less than 0, if the partnership had a loss, you're not going to go in a negative direction, so you're just going to get 0 on that. Employees of a partnership is going to be very similar to what we saw as employees of the Schedule C. Same as the first time, wages up to 100, add the contributions for group health plus the 4 new buckets, contributions for the retirement plan, and then the state and local, add those up on the monthly basis or the annual basis, divide by 12 times 2.5, 3.5 in the food industry is going to get you the maximum loan. S Corps and C Corps are going to be the same way. We're going to take the total employees, take their wages up to 100, go through those same steps, multiply by 2.5 or 3.5, depending on the industry, to get the maximum loan amount. I will tell you there is a nice FAQ document that we're going to reference in a little bit here, how to get the maximum loan amount. That's actually on the Treasury website. Pretty extensive document, but it does go through a lot of these examples that I put here. Revenue reduction. So in order to qualify, as we said before, you need a 25% or greater reduction in revenue for the same quarter in 19 to 20. That includes Q1. Even really before COVID hit, they're still saying that that counts. So Q1 through Q4, if you had a 25% decline from year over year, 19 to 20, you qualify without having to look at the quarterly declines. And PPP revenue does not, or PPP loan proceeds don't count towards revenue. So this wordy definition that's out there, this is the SBA's definition when they talk about size standards. So this has been out there for years. I highlighted the most important part, which is the sales of products or service, interest, dividends, rents, royalties, fees, or commissions reduced by returns and allowances. It's a little bit of a wordy definition. There's a lot there. So the Treasury actually gave us a little bit of a benefit and broke it out by for-profit and nonprofits to have a little bit better to read explanation of that drop. So as you're going to see at the bottom of these slides, this came from that Treasury document that I previously referenced on how to calculate revenue reduction and maximum loan amounts. So this is straight out of the Treasury and SBA document. So right at the top there, gross receipts are generally all revenue in whatever form received or accrued. Now, the big thing here is that it's in accordance with the entity's accounting method. So cash or accrual, depending on how you account for items. And the definitions match the IRS on that last line there, that first paragraph, which is important. So what do gross receipts not include? We're not going to see this a lot in Delaware, but in a lot of states, we're going to have sales tax. So sales tax, which are collected and then remitted, do not count as gross receipts. There's 2 other ones on there, not probably as common, but put there for your reference. And down at the bottom, the one thing that hopefully is clear cut, but may not be, is that any kind of payroll costs or payroll taxes there may not be excluded from gross receipts. There's a little bullet point there. So let's look at nonprofits. Again, straight from the Treasury website on this. So this is going to be essentially contributions, gifts, grants, dues. It does talk about UBIT revenue. So the gross receipts for anything that qualifies as UBIT. The one thing to point out here is that the investment income does count. And if we go back to the for-profit one, it excludes gains and losses here, but it includes the interest and dividends. Nonprofit seems like it includes all investment income. All right, so let's move forward. Revenue decline documentation. So any loan that's requested under $150,000, no support's required at the time of application. On the time of forgiveness, it is required, or at the request of SBA. One practical point that I want to kind of mention here is that I've seen some banks in the area request documentation for loans under 150. So just be on the lookout that you might want to have that prepared. I'm not going to mention lenders, but there was a few in the local area that were actually, for loans under 150, weren't letting individuals move past the application point without uploading that information. But the rule specifically states that under 150, you don't need it at the time of application. Over 150, you have to provide that when you are applying. So what do we need to provide to the banks with the application to prove the 25% revenue decline? So the first one is quarterly financial statements. The big bullet point I'll make sure I point out here is that if they're not audited quarterly financial statements, the applicant has to sign and date the first page and initial all other pages attesting to their accuracy. So any internally prepared financial statements that you're going to use to show that decline have to be signed and initialed to attest to accuracy. They do put this second one in here, which seems a little silly, but a lot of work. So quarterly or monthly bank statements. Looks like they need to be marked up to show really what on that bank statement is a gross receipt and not transfers, capital infusions, etc. The third bullet point is the annual tax return. So as we know, we're right in the middle of starting tax season, and a lot of e-file hasn't even opened for a lot of different individuals, especially Schedule Cs. So the IRS says that you can fill out a draft of that and basically say, here's my gross receipts, and give them a draft of your return as well. So those are the three areas of documentation that can be provided to substantiate that 25% decline. All right, how to apply. So we talked about the first draw loans, which are individuals who did not receive a loan the first time. They are going to use a form 2483 application form. And individuals who are doing a second draw are going to do 2483 SD, which is second draw, and that's for the second draw application. So if you were to look at both of these forms, they are pretty similar. The second draw is about 6 pages long. The first draw is about 5. So the one thing I want to point out on those is that they do have that new purpose. So we're going to talk about this. There are operations expenditures, property damage, supplier costs, and worker protection expenditures. Those are new on the applications. In addition, there is still the assertion that current economic uncertainty makes this loan request necessary to support ongoing operations of the applicant. That was on the first one. That caused a lot of stir on, what is economic uncertainty? What is the uncertainty there of the applicant? that kind of prompted that loan necessity questionnaire on those over 2 million. So just make sure that you are signing off to assert that. And then the applicant has realized the 25% reduction in gross receipts is on there. The other third one I'll point out that's on the application that you need to sign off on is that you received a first draw PPP loan, and before the second draw, you will have used the full first draw. So we talked about that previously. That actually has to be signed off on the application on the second page. The other thing I mentioned earlier a little bit too is the first loan was trailing 12 months or 2019 when you were applying in that March, April time period. If you're going back to the same lender, which would be usually preferred, they have a lot of your data the first time. So the assumption would be that the second draw loan would be pretty smooth and has been for a lot of clients. If you use the trailing 12 months on the first application instead of 2019 specifically, you are going to have to modify that and use just 2019 or 2020, whatever is in your best interest and is higher there. We're going to talk about loan forgiveness on this last part. So there are 3 forms that exist for forgiveness. There is over 150. Or that should say under 150, excuse me, on that slide. So under 150 uses 3508S. That is the new simplified form. That's the form we have been waiting for a while. We're going to jump into that form in a minute here, and you're going to realize it's probably not as good as we had expected. If you're over 150, you're going to either use the short form, which is the EZ, or the long form. All right, so let's jump into the short form here. Now there's 2, this is the one that came out of the CAA. If you remember, there was a form that was 50,000 or less, and there's a little bit of, people were quite upset that it was only 50,000 of a loan and not the 150 they'd been talking about. So the CAA in December, the law changed that to move it up to 150. It's a simple form until you start reading the details. So the front page of the form, it has 2 assertions, which are right there. The first is compliance with the rules. The second is the certification everything is true and correct. And then it just requires a signature. So on the face, the form looks like it's great. So anyone who uses this loan, this is for your first or second draw. And it has that check mark right on the form. This is my first draw PPP loan or my second draw. So if you haven't applied for forgiveness yet, looks like a lot of people haven't, you're going to have to use this form. So if you dig into the details of this form, it has a little bit of an issue. It talks about if loans are less than 50,000, they don't really care so much about the details with the requirements for FTEs, etc. But if it's over 50,000, but under 150, you still need to comply with the reduction in staffing or the reduced pay, which is essentially the same as the EZ form. So they're giving you a 1-page form here to fill out, but it still is going to pull in. We're going to switch over here to the next slide. Oh, bring that back up for me, Jenny. So the next slide we're going to bring up here in a second is going to be a screenshot of the EZ application. And if you were to look at the Paycheck Program forgiveness form for the short form, there's a section on the 5th page that talks about borrower responsibilities. It essentially lists these items that are present on the screen. So if you have a loan over 50, but under 150, you can use the short form, but you still have to do the calculations to make sure that you have not reduced salaries for individuals, or you have not cut employees. And if you have to modify the forgiveness, which basically means you have to go to the 3508 EZ, which you're probably not going to qualify for. So then you have to go to the long form. A little confusing there, but the takeaway is if you're over 50, under 150, and you had a reduction in your staffing, you had a 25% cut in salary, you're probably going to need to do the long form. And that's on an individual by individual basis on forgiveness. So that's a little iffy. So here again is the EZ form, how you qualify. There's those two check boxes. The first one is the borrower would not reduce annual salary or wages by more than 25%. We just said that. And the end is important. The borrower would not reduce the number of employees or the average paid hours of the employees between January 1st, 2020 and the end of the coverage period. This is the same assertion that's on that 3508S form. On the bottom there, the other option is the borrower would not reduce any annual salary or wages by more than 25%, and the borrower was unable to operate during the coverage period. So you'll see that the first assertion is the same about the reduction of 25% or more. And that's consistent in both, and on the short form. The bottom section is the reduce the number of employees or you were in a shutdown. All right, so let's move forward here to the changes to the purposes of the loan for new areas. These are what we talked about earlier. Property damage is the first one. This is related to any disturbances that occurred in 2020. Worker protection expenditures, there's a definition there, but what you're spending essentially to protect your employees. Supplier costs and operations expenditures. Those are big. Remember, it's still 60-40, but out of that 40%, you could use some of these buckets which expand outside of the normal areas. I know that's a lot of information of where we are currently. Again, as we said, Q&A is going to be open on this. We'll try to go through that at the end. If there's anything specific, please reach out to your contact at Belfint. We can talk you through the forgiveness and the new areas of the application. The last section I want to go over real briefly before we switch over to Mike Kelly and the employer retention credit is where are we going to go from here? So the CAA added $284 billion in funding for this round of PPP, which is the first-time borrowers and for the second draw loans. The lenders and the prior administration are both saying they expect there to be enough funding. As I said earlier, January 19th, SBA came out and said only $5 billion had been used. We saw Bank of America and Wells Fargo come out. They had very low dollar amounts. I think each were under $10 billion and where they were out at after January 19th, which was when the second draw opened. SBA puts out guidance on that occasionally on how much of the funding is left. But right now we're not hearing that that's running dry imminently. The other thing I want to point out is that there is public disclosure of loan documentation. So the SBA has this website for every person who got a PPP loan and how much they got, who they are. It's organized by under 150 and over 150. It can be run by state. So just keep that in mind as we go forward. There will be disclosure of documentation and it will be made public. Changing of Treasury and SBA guidance. As I said before, we just got new guidance last week. They continue to update the information. What we said today is going to be true as of today. It could be different as of tomorrow. And then we're going to have to work on submission for forgiveness on those first draw loans and the second draw loans. Keep in mind that each loan has to be applied for separately for forgiveness. So just because you have a first draw loan or a first loan that you got back in 2020, you haven't requested for and you're getting a second one, each one must be applied for separately. So you're going to actually be doing, you get a second draw loan and you haven't applied for the first one, you will be doing 2 separate applications for forgiveness. Mike Kelly is going to kick off the employer retention credit, which came out of the CARES Act and then got modified a little bit here. So again, if you do need help with this, feel free to reach out to us. We're here to help. And with that, I'm going to send it over to Mike Kelly to talk about the employee retention credit. Mike?
Hey, John, thanks. As John said, my name is Michael Kelly. I am going to talk about the employee retention credit. And the PPP program has certainly gotten well-deserved hype, and it's very well-deserved, but the employee retention credit could be a little known diamond in the rough if you were eligible for it. As John said, it did come out of the CARES Act along with PPP number 1, and most CPAs really didn't have to pay that much attention to it because they made it very clear in the beginning that you could not double dip. You could not get a PPP loan and an employee retention credit at the same time. But the December tax law change has now gone back on that. And they said, if you're eligible for the employee retention credit, then you can get that and the PPP. Okay, so that's why we probably haven't heard a lot about it up until this point. So before I start digging into these slides, I do want to kind of highlight a few things. The employee retention credit has kind of a different set of rules for 2020 and 2021. So there's 2 different types of rules, and I'm going to try to highlight those rules as we go along. So that's important. The second thing is, the IRS has put together a beautiful list of FAQs on their website talking about the employee retention credit. But at the very top of those FAQs in bright, bold letters, it says these FAQs have not been updated for the tax law change from December. So it's a lot of good information. I think it's a lot of good stuff that we can still apply for 2020, but we are missing or would like to see a little more guidance about certain things. We want to see more guidance about how the employee retention credit interacts with the PPP. We want to maybe see a little bit more guidance on if you had wages that were eligible for the ERC earlier in the year, how you can go about applying for that now. And we'll talk about both of those items a little bit later on in the presentation. But that's just kind of high level things that I want to highlight. All right, so let's dig into this. So how much is this employee retention credit? That's the most important question. The employee retention credit is a credit that's going to be up to 50% of wages paid to employees. And that's going to be capped at $10,000 per employee. So 50% of 10,000 is up to $5,000 credit per employee, and that's for wages paid to them. Okay. The wages for 2020, the eligible wages have to be paid after March 12th through December 31st. The wages paid for 2021 have to be paid in Q1 or Q2 of 2021. Now, 2021, you're going to notice as we go through these slides, everything gets a little bit more generous. In 2021, instead of just allowing a credit of 50% of wages paid, they're going to allow 70% of wages paid, and it's going to be based on a per quarter analysis. So that's 70% of $10,000 per quarter per employee. All right, that's a big difference compared to 2020. So let's look at an example, because I like numbers. At the top of the slide, you're going to see a 2020 example. At the bottom, you're going to see a 2021 example. And let's quickly roll through this. Assuming that I'm eligible for this employee retention credit, I'm going to shorten that down to ERC. I pay employee $8,000. I could maybe get a credit of $4,000. Easy enough, 50%. Employee B, I pay 10 grand, 50%, $5,000. Employee C, I pay them $12,000, but I'm limited to $10,000 per employee. So my credit on employee C is going to match up my credit on employee B, who I only paid 10 grand. So you get capped out 10,000 per employee for the entire year, starting on March 12th. Now we're moving forward to quarter 1, quarter 2 of 2021. Stakes get a little bit higher here. I pay employee $5,000 quarter 1, $5,000 quarter 2. 70% of each of those amounts is $3,500, so I can get a credit of $7,000 on wages paid to employee A. Employee B, I pay $10,000 each quarter of 2021. That's a $7,000 credit for each quarter, $14,000 total credit. And then employee C, if I pay them 20, I'm going to end up in the same boat as employee B because I'm past the $10,000 threshold, $10,000 per employee. So who's an eligible employer? The government has been giving out a lot of money, but they're not going to necessarily give to everybody that pays wages to their employees. And it's broken down into 2 buckets of who can claim this credit. The first bucket is were you shut down by the government for COVID-related reasons during a quarter? And if you were shut down during that quarter, then any wages paid during that quarter should qualify for the credit. That's a full or partial shutdown. And we'll talk a little bit more about that later on. Or you have a significant decline in gross receipts. Comparing 2020 versus 2019 or 2021 versus 2019. It's kind of similar to what John was talking about with the declining gross receipts for the PPP, and we'll talk more about that. One thing I just want to highlight that this credit is not there for self-employed individuals to claim based on their own earnings against their self-employment tax. But if they have employees, they certainly could be eligible for this credit. So let's talk about what is a significant decline in gross receipts. Again, you either got to have a significant decline in gross receipts or you got to be shut down by the government to be eligible for this credit. Before we talk about a significant decline in gross receipts, we need to talk about what is the definition of gross receipts. And similar to what John was talking about, we got a very wordy definition, probably very similar to the definition he put up there, but the IRS on their FAQs specifically references code section 448C. And I think in the most simplistic terms, I think if it hits your tax return as a gross receipt, then it's a gross receipt. As far as counting the PPP loan as a gross receipt for this test, I like to think it's not going to count. But since we are talking about a different code section, John talked about gross receipts as defined by the SBA and clarified by the IRS. I cannot guarantee that they're not going to call a PPP loan a gross receipt. I like to think they're not. But I would like them to come out and say it, just like they have come out and said it for the PPP test. Okay, so what is a significant decline in gross receipts? It is very, very similar to how John put it. I take my first we have 2 different time periods. We got a 2020 time period, right? Because we have 2 different credits here, the 2020 credit and the 2021 credit. So for 2020, all I do is I take a quarter in 2020, I compare it to the same quarter in 2019, and if it drops by 50%, then I have a significant decline in gross receipts. I am eligible for a credit on wages paid during that quarter. Small caveat, if I happen to have that drop in the first quarter, then only wages paid after March 12th through the end of the quarter counts for purposes of this credit. Now, once you have that drop in gross receipts, you continue to be eligible for the credit moving forward to future quarters. And you continue to be eligible until you get to 80% of gross receipts of the prior quarter, or the prior year quarter. So we'll show an example of how that works. But even if you get up to 80% the next quarter, you still get to claim a credit on wages paid during that quarter one last time. One last time. And our example kind of, I think, will highlight that. 2021, the 2 quarters in there, it gets easier. You don't have to show a 50% drop in gross receipts. All you have to do is show a 20% drop in gross receipts. So that's cool. That's much easier. Of course, it's never cool to have a drop in gross receipts, but these credits are pretty powerful. So to be eligible for them is the cool part, I guess. All right, let's look at this example. Again, I'm breaking this out into 2020 versus 2021. We have different rules, 2020 versus 2021. Quarter 1, 2020, you can clearly see in 19, I had $100,000 of gross receipts. 2020 in quarter 1, I had $40,000. I'm only at 40% of what I was in 2019. I have a reduction, a significant decline in gross receipts. I am eligible for credit for wages paid in that quarter, but remember, quarter 1 special, it's got to be wages paid after March 12th. Quarter 2, I'm still beneath that 50% mark. I still have a significant decline in gross receipts. I'm still eligible for the credit. Quarter 3, I have a recovery to 85%. But even though I have that recovery during that quarter, I get to have one last time of claiming these credits on wages paid to my employees. Quarter 4 comes. Now I got to go back to meeting that 50% test. I don't meet it, so I'm not eligible for the credit in quarter 4. 2021, different set of rules. We don't need to show a 50% decline in gross receipts. All we have to do is show a 20% reduction. So 2019, I had $100,000 of receipts, $75,000 in quarter 1 of 2021. I have a 25% reduction. I'm good. I'm eligible for the credit. And I think we can probably file, unless I'm didn't see a new rule out there, I think we can follow the same methodology. And if I'm eligible in quarter 1, then I should be good moving into quarter 2, even though I'm at 81% in quarter 2. This is right from the IRS FAQs. Does a significant decline in gross receipts have to be COVID related? Answer, no. If I'm a business and I had like 5 stores open, retail stores open 2019, and I knew all along I was going to close a few of them in January of 2020. COVID hasn't even touched our soil. Well, maybe some people think it did, maybe it did, but for the most part, we weren't really that worried about it in January 2020. This owner closes a couple of his stores in 2020 before COVID even arrived. Naturally, we're going to have a decline in gross receipts during 2020. How big is it going to be? I don't know if we're going to make it to the 50% threshold, but if we happen to make it to that 50% threshold, the IRS do not want to get their hands dirty with trying to figure out whether your decline in gross receipts was related to COVID or not. Does your employee count matter? Yes, it does. It could matter. Different rules for 2020 and 2021. But starting with 2020, if I have employees, total employees less than 100 employees, then pretty much assuming I'm eligible for the credit, any wages paid to those employees should count. It's when you go above 100, you may have an issue. If you pay your employees to stay at home, then only those employees, and do nothing, not provide services to you, only those employees would be eligible for the credit if you have more than 100 employees. So the folks that are coming to work for you, that unfortunately would not be eligible. That 100 employee test moves to 500 employees in 2021. So again, everything's more friendly in 2021. Okay, so we talked about a couple buckets in order for you to qualify for this credit: significant decline in gross receipts, or the government has to fully or partially shut you down. Fully shut down, I think, is kind of obvious. When the government comes in and says you can't do business at the moment. Now, I don't know. The only question I really have is, what happens if they just shut you down for a day? Does getting shut down for one day make you eligible for this credit for wages paid during the whole quarter of being shut down for one day? I don't know that answer. But certainly, government comes in, shuts you down for a week, 2 weeks, that starts having an impact on your business. And I think that would be enough, to allow you to claim credits on wages paid to employees during that quarter. Partial shutdown, not quite as obvious, and the IRS has issued some good FAQs on that. So I'm just going to pull right from their FAQ with a good old-fashioned restaurant example. Restaurant provides dine-in and takeout services before COVID comes. COVID comes, government comes in and says, no more dining in, takeout only, Mr. Restaurant, that's all you can do. IRS says that is a partial shutdown, and that's good enough for you to get the credit for wages paid to employees. What happens? The government comes in and says, no more indoor dining still, we'll let you do takeout, we'll let you do outdoor dining. IRS says that's a partial shutdown. What happens if the government comes in and says, okay, we'll let you sit some people inside. To what capacity? I don't know, but it's a limited capacity. IRS makes it clear that's a partial shutdown still. And they like to throw around this phrase, anything that has more than a nominal impact on business operations. Well, nominal means small. So you just got to show that anything that's having more than a small impact on your business operations. What happens if you were a Domino's, and maybe, I haven't been a Domino's since I was a teenager, but they may have 1 or 2 tables right in that takeout area, but they're pretty much just a takeout type of business. I would imagine if government comes in and says no more sitting at those 2 tables in Domino's restaurant, I would say that is just a nominal impact on their business, and that would not be considered a partial shutdown. This is another example that's similar to the Domino's. I have a grocery store, has a salad bar. Government comes in and says, hey, grocery store, no more operating that salad bar, COVID-related reasons. That would just be a nominal impact on the operations of the grocery store, and that would not be considered a partial shutdown. So that's right off the IRS FAQs. I think this is a relevant question. If my employees are forced to telework, could this be considered a partial shutdown? And the IRS pretty much says, listen, if you were able to continue on with operations as normal, what you were doing before COVID-19, and you can still do it after COVID-19, probably not going to be a shutdown. But if your employees are extremely limited to what they were doing now compared to what they were doing beforehand, then you might have an argument for a partial shutdown. Got this question right from a client, and the IRS had it right on their website as an FAQ. I have an essential business, so I'm allowed to keep my business open during a shutdown. The government has pretty much told their residents, we only want you going to the grocery store. We don't want you going anywhere else. So even though I'm an essential business, I'm open, government's not really letting anyone in my place of business. Can I blame that, call that a shutdown on me? Even though it's on my customers, restricting my customers, it's impacting me. And the IRS makes it very clear that's a no. They say, listen, if it's hurting you that bad, then you got to go to the significant decline in revenue test, not the partial or full shutdown test. And the example they use here is just an auto repair shop. Makes sense why it would be essential. A little known fact that I don't know if enough people are paying attention to, the related party payments are not eligible for the credit. So if I have mom, dad, son, daughter working in my business, pay them wages, can't take a credit on them. It's a little bit different than the PPP program, which seems to be a lot more liberal in allowing those type of wages to count for forgiveness. Okay, how do you claim the credit? Well, this was one of the first things I highlighted where I'd love to get just a little bit more guidance on, because there's kind of some wishy-washy information out there. But we certainly know that you claim the credit on your 941. But for those, no one has been claiming this credit if they got the PPP, right? We said early on you couldn't do both, but now you can, and now you can go retroactively fix this. But how do you go about retroactively fixing it? I mean, the guidance as I'm reading it is you can do, so even if you paid wages in quarter 2, quarter 3, because you had a significant decline in gross receipts, or you had a full or partial shutdown, even if you paid those wages during quarter 2, quarter 3, instead of going back and amending those quarters, I think you can claim that credit on Q4 payroll tax filing as a catch-up. Now, unfortunately, Q4 is due next Monday, I believe. So, we're in a logjam right now as a firm trying to, look at these items before the due date, but knowing that we're probably not going to be able to look at all our clients' returns before then. So we're probably going to recommend, hey, client, file Q4, and then we'll probably have to go back and amend it. Here's just a quick and dirty example for how the credit works on the 941. So picture your 941, you report some wages on there. In this case, we had $25,000 of wages, but we're limited $10,000 per employee. Again, this is 2020 wages, so we're assuming you're limit to a $5,000 credit down here. On your 941, you got to show all the taxes that you withheld, whether it's Social Security, Medicare, federal withholdings. Maybe you made some deposits in during the quarter. But in this case, we have $6,500 of total taxes that we're showing on the 941. I would expect you to get, if you already paid those taxes in, and when you file your 941, you can claim them back, and you can claim the excess above them. Okay, the other item we're looking for a little bit more guidance on is how the ERC interacts with the PPP program. Now recall, like John said, that when you get a PPP loan, you have either 8 or 24 weeks to spend it. And I think they may change that up even more, where you can pick your own cover period, but you got to spend that money. You got to spend it in a certain way. You got to spend it on things like wages, utilities, rent, all those things John mentioned. And what the one thing they make clear is, if you spend your PPP funds on wages, then you can't take an ERC on those same wages. So we got to be able to pull out these wages that are not getting used for PPP purposes. The problem we have here is a bunch of PPP applications have been filed. And let's do a quick example. I had a $100,000 PPP loan and I already filed my application. And I wanted to do everything the right way. And I happened to pay $200,000 of wages. And I reported that on my PPP application. I didn't need to report $200,000. All I had was a $100,000 loan. Gosh darn, all I needed to do was report $100,000 wages, and then the excess I'd like to use on the ERC, get a 50% credit on that excess. And right now, we're waiting on guidance from the IRS to tell us what that means if we already filed a PPP application. Did we lose out on that excess? That doesn't make sense. Hopefully we should be able to get that. So let's just look at a very basic example of how the interaction works. The first column here shows we're not considering the ERC at all. We got a PPP loan, 100 grand. We have $70,000 of wages, and we have a bunch of other expenses. So we have total expenses of $120,000, but all we need is $100,000 of expenses. So I pull out $12,000 of wages off my 72 because I don't need it. And I pull off a little bit more out of the utilities. Again, because I don't need it, but it doesn't really make a difference for what we're about to talk about. But that $12,000 I pull off, I can now use on my ERC, and I can get a 50% credit on that. Now you may wonder, Mike, why don't you pull off 20 grand of wages? But we also have to kind of keep in mind that these wages, we need to aim for them to be 60% of the PPP loan, like John mentioned, or we may face a reduction. We may face a reduction. We have to do the math. Easier part, taxability. Right now, the IRS says if you get a $5,000 credit for ERC, then I lose a $5,000 wage deduction for it. It's right on their FAQ, so it's a little bit different than a PPP. PPP, you don't have to pay any taxes on it. If I do get a credit, then I do lose a little bit of a deduction. So, in closing, the ERC, not as well known as the PPP, can be very powerful. I just did an analysis for my client this past weekend, and it's kind of really in the sweet spot here. Right now, I found at least $100,000 of wages that we may be able to use on the ERC. That's essentially PPP number 3. That's what I call it, PPP number 3. So if you have that reduction in gross receipts, if you have been shut down by the government, you may be eligible for it.
Valerie Middlebrooks is going to be our next speaker. Valerie is a shareholder and director at Belfint Lyons and Schumann, and Valerie in our tax and small business department. And as a matter of fact, Valerie also heads our tax and small business department. So Valerie, I know you have a lot of additional information that came out in the COVID Relief Act that was passed back in December. So I'm going to turn everything over to you.
Great. Thank you, Jordan, and welcome everybody. I just wanted to reference our COVID Resource Center. I don't think we mentioned that yet. So on the screen, it shows the link to our website. We have been trying to post things in a timely manner to try to keep everybody up to date as the guidance has been coming out and changing. So I'm going to cover a variety of other topics, some in the CARES Act, some in the COVID Relief Act, that we thought were the most relevant. Since I don't have tons of time left and we want to make sure we get to your questions, I'm going to try to get through as much as possible, and then we'll stop right around 10:15 so that we can get to the questions, if not a few minutes earlier. So the first thing I wanted to mention is the economic impact payments, which we've been seeing so much press about. The CARES Act provided for round one of the economic impact payments, which were $1,200 for a single individual, $2,400 for a couple filing jointly, and $500 per dependent. They were initially based on your 2018 or 2019 tax return. There were AGI thresholds, so higher income taxpayers, as reflected on your last tax filing, were not eligible to receive payment. The payments are not taxable to you. In fact, they're considered a tax rebate credit. So what's going to happen is on your 2020 tax return, you're going to actually reconcile the payments you either received or didn't receive, or if you were eligible or not eligible. If you did not receive the amount of payments you should have received, you'll be able to either decrease your tax liability or increase your refund based on the amounts that you should have gotten. If you did get more than you should have gotten, the government's being very considerate and is not requiring that those payments be repaid or that you increase your tax in any way related to an overpayment. The second round of impact payments came out with this last COVID relief bill. This round is $600 per single individual, $1,200 for a married filing joint couple, and $600 for each additional dependent. Again, it was based on the your AGI on your 2019 return to determine whether you get payment or not. And again, the second payment, even though it's coming in 2021, will also be reconciled on the 2020 return, similar to the rules I just discussed. Okay, COVID-related distributions from a retirement plan. So an early distribution from a retirement plan before age 59 and a half, which is generally the limit, would be subject to a 10% additional tax penalty. The CARES Act, however, provided that this additional 10% tax penalty will be waived in 2020 for any COVID-related distributions. So what is a qualified COVID-related distribution? It's somebody who either has been diagnosed with the virus, has a family member who's been diagnosed with the virus, or someone who's experienced adverse financial consequences because of the virus. So pretty broad-based. However, once you take a COVID-related distribution, there does not appear to be any limitations on how you actually spend those amounts. The aggregate amount of a distribution that can be deemed a COVID-related distribution is $10,000 per individual. Now, just because they're waiving the 10% penalty does not mean you don't have to pay tax on these distributions. You still have to pay tax. However, the CARES Act provided the option that you can actually spread the tax liability over 3 years, starting in 2020. You also have the opportunity to pay back these distributions within a 3-year period, starting on the date after you receive the distribution. And if you do go ahead and repay those distributions after you've paid tax on some of them, you can amend your return and get that tax back. Now, the newest set of legislation provided for sort of an add-on to this special provision for qualified disaster distributions. So basically the same type of COVID-19 related distribution. And what they did was they extended the distribution period into 2021 for another 180 days. And that actually goes to June 25th, 2021. Qualified medical expenses. So the CARES Act updated a few provisions related to medical expenses, which can be reimbursed from HSA and the like accounts. What they did was, prior to this, medications and drugs had to be prescribed by a physician. They eliminated that requirement for medication to be prescribed, and so now you can get pre-tax reimbursement for over-the-counter medication and drugs. They also expanded the definition of medical expenses to include feminine care products. Now, the COVID relief bill made permanent a provision that the IRS or the Treasury has been extending for a while. So several years ago, the AGI limit for deductible medical expenses was set to increase to 10%. Now, Treasury's continued to roll that back for a couple of years based on, everything that was going on. And this COVID relief bill actually gets rid of the 10% completely and makes permanent the 7.5% AGI limit for deductible charitable expenses. Charitable contributions. Oh, I think I just said charitable expenses. I meant medical expenses. Now we're going to talk about charitable contributions, though. So the CARES Act provided an additional $300 above the line deduction for taxpayers who do not itemize. For this purpose, the charitable contribution has to be a cash contribution, so no property, has to, of course, be to a qualified charity, same rule as before, but it also cannot be to a donor advised fund or a private operating foundation or a carryover contribution from prior years. The CARES Act also modified the limitation for the percentage of charitable contributions that can be used to reduce your income. It has been 60%, and for 2020, they've raised it to 100%. They also gave a little bit of break to corporations. Prior to this, corporations would have been limited to 10% of their taxable income for charitable contributions, and they've increased that to 25% for 2020. They also increased for corporations the limitations for donation of food inventory. The prior limitation was 15%. That also has been increased to 25% for 2020. Now, the COVID relief bill makes a few adjustments, or I should say a few extensions to these provisions. For 2021, individual taxpayers, individual non-itemizing taxpayers are eligible to take up to $600 for joint filers. So it would be $300 for single filers still, but $600 for joint filers as an above the line deduction in 2021 for qualified charitable contributions. And then they also extended the 100% limitation for total charitable contributions to also cover 2021. Educator expenses. So there's an above the line deduction available for educators for unreimbursed classroom expenses. The COVID relief bill designates personal protective equipment and cleaning supplies as eligible expenses for this deduction. And that relates to supplies purchased after March 12th, 2020. Business meal provisions. So generally business meals are deductible, but they in the past have been limited to generally 50% of your expenditures. Under the bill we just got for COVID relief, business meals provided by restaurants, and that's the key here, it has to be by a restaurant, are 100% deductible in 2021 and 2022. So again, giving a little break to our restaurants who have been very hard hit for all this. Provision of losses. So the CARES Act provided a temporary repeal of the taxable income, corporate taxable income limitations. Previously, NOLs had been limited to 80% of taxable income, but for 2020, those losses will be allowed up to 100% of taxable income. Actually, I think it's for 2018, 19, and 20. Modification of rules relating to the NOL carrybacks. So prior to this, NOL carrybacks had been disallowed, carry forward only. So the CARES Act now allows that you can carry back losses incurred in 2018, 2019, and 2020 for 5 years. So the modification of these rules, provides an opportunity to amend returns and possibly get refunds if available. The CARES Act also modified the limitation for non-corporate taxpayers, so individuals. So prior to this, there were limitations on how much business loss could offset other types of income. Generally, it was approximately $250,000 for individuals or single individuals and $500,000 for joint taxpayers. Any losses above that were disallowed and you were required to carry them forward. The CARES Act, again, modifies those provisions, allows losses to be fully deductible regardless of the amount in 2018, 2019, and 2020. Employer paid sick leave. So the Families First Act provided for refundable payroll credits for qualified COVID-related leave taken between April 1st and December 31st, 2020. So basically, eligible employers who were required to pay employees out on this required sick leave during this time period were able to take a credit on their payroll tax obligations up to $5,110 per employee. So the first program ended December 31st. However, the new COVID bill does extend this program through March 31st, 2021, even though employers are no longer required to pay that type of leave, but if they opt to do so, they can continue to take the credits. A lifetime learning credit changes. So under pre-tax law, the lifetime learning credit had a very unfavorable phase-out range. Based on the new act we got, they actually made some changes and aligned the phase-out range for the lifetime learning credit to match that of the American Opportunity Credit, another education credit, which had a more favorable phase-out range. So the result is that the phase-out range for the lifetime learning credit will increase by approximately $20,000 for a single taxpayer and approximately $40,000 for a married filing joint taxpayer. So hopefully, a broader base of taxpayer will be able to actually take the credit. And this is for educational expenses incurred starting in 2021. Okay, so the next slides are going to be about the payroll taxes. So there were two provisions for payroll taxes deferment. One was related to the employer portion of payroll taxes, and the other one was related to the employee portion. So the first one, the employer portion, allowed employers, including self-employed employers, to defer their 6.2% of payroll taxes for a period from March 27th through December 31st, 2020. Any payroll taxes deferred under this provision now have to be repaid 50% by December 31st, 2021, and the remaining 50% by December 31st, 2022. Originally, there were limitations related to delaying payroll taxes in PPP, but those have been waived. So the second provision was a presidential memorandum which allowed employers at their discretion to defer withholding, remittance of the employee portion of the 6.2% Social Security tax. So it covered a period from September 1st through December 31st, 2020, and it required repayment of payroll taxes deferred under this provision by April 30th, 2021. And this was, you could defer on biweekly wages of $4,000 or less per pay period. The Consolidated Appropriations Act added a caveat to this and now extends the repayment period. So employers and employees now have until December 31st, 2021 to repay any amounts deferred in 2020. Bonus depreciation. So TCJA contained a provision to qualify a number of leasehold improvements that they call qualified improvement property as eligible for bonus depreciation and 100% deductible. However, there was a drafting error in TCJA, and that actually did not happen. So the CARES Act fixed the drafting error, and also made it retroactive. So it was originally supposed to go back to items purchased after December 31st, 2017. CARES Act made it retroactive back to that date. Now you can deduct for qualified improvement property 100% under the bonus depreciation rules. So that gives you an opportunity to go back and amend 2018 and 2019 returns for this provision. Okay, last, Delaware relief grants. So at least 51%, in order to qualify for a Delaware relief grant, at least 51% of the business's operations has to be in Delaware. So just being organized in Delaware is not enough to get a grant. Businesses and nonprofits were eligible to receive up to $100,000 based on their 2019 revenue. Grant recipients must now show that they actually had a decline in revenue from 2019 to 2020. So no percentage limitations anymore, but just a decline. For grant recipients who actually ended up not having a decline in revenue in 2020, they'll have to repay those grants with interest. However, Delaware is allowing the grants to be repaid by February 15th, 2021, and no interest will be charged. There have been several bonus rounds related to these Delaware relief grants. I think we're on the 4th round right now, which started, I think, last week. So the last thing I want to mention about these Delaware relief grants, actually 2 things. One, at this point, we still consider them taxable income without further guidance. And 2, they, very similar to the PPP, need to be spent for specific types of expenses. The first round relates to, I think I have a slide about this. Yeah, so the first round related to PPP related equipment and debt financing, technological improvements, and advertising directly related to the COVID-19, as well as certain taxpayers could use rent, mortgage, utilities, insurance, and the like. The bonus payments can be used on valid business expenses, which I believe includes the items that I mentioned previously, as well as payroll and inventory. So I think at this point, I'm going to turn it back to Jordan to open it up for Q&A.
For a question. Thank you very much, Val. And Val, if you would stay on, and John and Mike, if you'd like to pop back on as well. We have a question and answer session now for the next 15 minutes. We do have a lot to cover here. So let's get right to the Q&A session. Guys, one of the questions deals with how the states are handling the forgiveness. We know, there's federal forgiveness on these PPP loans. We know Delaware has come out and said that if it's forgiven for federal purposes, it's forgiven for Delaware purposes. One of our attendees is asking about Maryland. Did you know if Maryland or any of the other surrounding states are also forgiving these loans?
We've heard that Pennsylvania posted that they're following federal and it won't be taxable. I have not seen any guidance from any other surrounding states currently. I don't know if Mike or Val has, but I haven't seen anything specifically on Maryland.
Yeah, I haven't either.
Okay. New applicant, this participant sends in a question, new applicant in 2021, first draw loan. Must they still assert economic uncertainty as a requirement of the loan?
Yes, they need to on the application.
Okay. What about, are there any?
Jordan, I just wanted to ask John, with the first round of PPP, economic uncertainty was defined as just applying for a loan less than $2 million. Does the same hold true for PPP number 2? I mean, just by getting a loan less than $2 million, can you just assert that?
They haven't updated the FAQ on that, Mike, so that was the issue with round 1. I haven't seen any guidance come out on round 2 to address that. It's just the assertion that is on the application still. So no additional guidance that I've seen on that yet.
So here's a question related to the to obtaining the loans. Are all banks participating in the loan program, and or do you have to use your bank that you do your business banking with to obtain the loan? So, and let me just add to that. You know, if you're allowed to use another bank, should you be going to, you know, one of the large banks, one of the smaller community banks? Is there a preference that Mike and John, that either of you have?
So I know that a lot of the larger banks require a business checking account to apply. So you need to have a relationship with the bank in some capacity in order to apply. The smaller banks, more of the community banks, do not necessarily have that requirement. They are more well-versed in SBA compliance, and they're more used to dealing with these type of SBA loan programs, where the larger banks are not. But knowing that it is a second round of PPP, there is some additional rule changes from the lender side. I just got an email. They're doing another lender presentation today at 2 o'clock, working through some hiccups in it. But the recommendation is to use the same bank that you used the first time, since they already have a lot of your data, and that should streamline the process.
Great, thank you. And I do want to let our participants know that John and Mike have spent countless hours following the guidance from Treasury and from SBA. And I know, John, you tell me that SBA is notorious for releasing their updated Q&A or frequently asked questions or guidance at 11 o'clock at night. Is that right?
That's right, Jordan. Usually 11 o'clock is the drop time for Treasury SBA guidance. So if anybody else wants to stay up late and read that great material late, it usually comes out there. And
I will vouch for that, because I will tell you that many mornings I have emailed John, said, "Hey, John, did you see this? SBA or IRS just updated." He said, "Already on it." And he already has an update for our website on it. So I don't know how much sleep you guys actually get, but kudos. A question regarding nonprofits, and I know you talked a little bit about, you know, gross receipts of nonprofits, but there's a question: do gross receipts include any unrealized gains on endowment fund investments?
It does not specify that in the guidance. It talks about realized gains, but it doesn't talk about unrealized. Now, the thing that you need to note is it says it's not limited to the following. So, and then it lists a bunch of items. So they could come back and say unrealized counts, but that's not doesn't appear to be in the intent of the guidance issued thus far. So that we may get a Q&A on that, or FAQ on that at some point from Treasury or SBA. But right now, unrealized gains and losses are not included in investment income.
Okay, thank you. I think, Mike, this one is probably for you. The question is, can you take the employee retention credit for 2020 and not 2021, and vice versa?
Yeah, it's whatever, whether you meet the rules, the revenue reduction rule or the partial or full shutdown, whenever that happens, that's your eligibility. So.
Okay. This next question is, let me just read it out here. Are you eligible for the employee retention credit even if a government shuts directly, resulted in the closure of your business, but your revenue was not 50% lower than the same period last year's quarter?
Yeah, the answer is yes. So it's one or the other, for partial shutdown or a drop in gross receipts. I think the for partial shutdown really protects you if maybe you don't quite 50% reduction in gross receipts, but maybe you have 49% reduction. So it's there to kind of protect you.
Okay. Let's see. Valerie, this one is, I think, for you, has to do with the education-related expenses. The question is, are education-related expenses only eligible K through 12, as the slide indicated?
Yeah, that's correct. So they don't include sort of higher, professors or higher education. So it reads grades K through 12, teachers, instructors, counselors, principals, and aides.
Okay. And actually, from one of our colleagues back at the office, and Val, you might want to just clarify this regarding the loan from the pension plan loan up to $100,000. That's a maximum allowed. Is that correct?
Yeah, I didn't actually talk about the loans, but the distributions are, yes, I believe both are.
Yeah, the distribution, not the loan. I'm sorry.
Yeah, are 100,000 per individual.
Right. And, we should also mention that this can come out of an IRA or for your pension plan. Is that correct?
Yeah, any qualified plan, which would include 401k, 403b, and IRA type plans.
Okay. So if I'm impacted, I can withdraw up to $100,000 from my IRA account, and if it's COVID related, and if I'm married, my wife can also do a withdrawal up to $100,000 from hers. So as a family, in that case, Val, I guess we can take up to $200,000.
Yeah, that's correct.
But only $100,000 from either one.
Right, and they have to come from separate plans. So a married couple can't take 200 from one plan. They would have to take 100 from each of their plans.
Right. Okay. Thank you. A question is the employee retention criteria the same for PPP 2.0 as for PPP 1.0? Not sure how those two are related, but John or Mike?
I think the question is, what happens if you have an FTE reduction in 2.0?
Okay.
FTE reduction doesn't impact the ERC.
And it would impact forgiveness on PPP.
Okay. And one of the last questions, I'm pulling this from the questions that were submitted along with registration, is, if one of our listeners needs assistance walking them through the loan application or the forgiveness application, or doing these calculations to see how much loan they qualify for, the calculation for the employee retention credit, who can they call? What services does Belfint Schumann provide to them? I'll open that up for anyone there. John, do you want to?
Yeah, so I'll go first. So we can assist with review of the application. We can assist with the preparation with your staff, or we can actually take on the full preparation of the forgiveness application and send you over documentation to submit to your bank after we run through the calculations. And then as far as ERC, Mike, do you want to talk about that?
Yeah, I would probably recommend that we handle the full calculation for it. And the reason being is this whole overlap with the PPP forgiveness process. You can't use the same wages for both of them. And I think we need to kind of get involved to make sure that doesn't happen.
And feel free to reach out to your contact at Belfint or to me or Mike if you have questions about services related to those topics as well.
Okay. And the last question that I see here is, if we don't have a 25% reduction in revenue, can we apply for for a PPP second draw without the intention of getting it forgiven? So I guess they're asking, okay, we don't have a reduction, can we still apply, and we know we're going to have to pay it back?
Yeah, so that's a good question. on the application, you're actually attesting to the fact that you had a 25% decline. They haven't addressed it specifically, but I would imagine that you are not going to apply without that 25% reduction.
Yeah, I think I heard something that says that's not a good idea. So if you're looking for that 1% loan that you're okay with eventually paying back, I think that's a bad thing. You don't want to do that.
Yeah, I tend to agree. I think we've come to the end of our questions. I want to thank John, Mike, and Val. You've explained a lot and clarified a lot, I know for me especially, in these very difficult areas. So again, if anyone has questions, please feel free to reach out to your contact at BLS or to Val, Mike, or John. Also, look forward. We're going to be having many more Belfint briefings just like this, because there is more legislation that is pending coming up. So we're going to try and analyze it for you and point you in the right direction. So with that, we're going to say goodbye to everyone. Thanks for being with us, and have a great day.